part 1 in our Corporations, Paid-in Capital, and the Balance Sheet series, and here we'll be discussing equity and stock. So first, let's make a distinction between what owner's equity is and stockholders' equity. Most of the time, I refer to the equity section of the balance sheet as owner's equity, just from sheer habit. But there is a difference in the two. And let's look at those. So let's look at owner's equity. Owner's equity is specific to a sole proprietorship. And we can see here John Doe owns this business, and under owner's equity we have John Doe's capital account. And that is also the balance in our owner's equity section. So if you look at your T account for capital here, we know capital carries a normal credit balance because it is an equity account. Therefore, we have our beginning capital balance, if any. Unless this is a startup company, it would not have a beginning balance. Any net income earned by the business would make the capital account of the owner go up. Any additional investments that the owner makes would make his or her capital account go up. And if the owner made any withdrawals, then that would make the capital account go down, and then leaving us with our ending balance in capital. So that's technically what an owner's equity section of a balance sheet would look like. It would have the capital account of the owner. A stockholder's equity section, we've talked about two things that show up. We've talked about common stock and we've talked about retained earnings. But now we can see that there's a little bit more involved. We have what's called a paid-in capital section in the stockholder's equity section of the balance sheet. And under paid-in capital, we have preferred stock and common stock, as well as paid-in capital in excess of par, which we'll be discussing. Those three things together give us what's called total paid-in capital. And then we add our retained earnings to that, and that will give us our total stockholders' equity. So again, just note that there is a difference in what's called owner's equity versus stockholders' equity. Now let's see a difference in our classes of stock. So the first one, this is the most basic form of capital stock. Dividends are paid based on how well a company does or does not do, and typically this type of stock will come with voting rights. We normally will issue this stock at or above par. This is called common stock. And keep in mind that par value is something that is arbitrarily assigned by the board of directors when the company is created. And it's typically set very low because, as you see, we want to issue stock at or above par. There's legal issues if that doesn't happen. Let's look at the other class of stock. This type of stock comes with certain advantages over common, and it is also typically issued at par. This is called preferred stock. Preferred stock will receive any dividends before common. Also, upon company liquidation, preferred stockholders will receive their part of the assets before common will receive anything. So remember your accounting equation: assets equals liabilities plus equity. Remember that liabilities was the debtor's claims on our assets, and they, of course, get paid first. If you liquidate, the debt gets paid first. Then, if there's anything left, preferred stockholders will get their portion of the assets. Then, if there's anything left, common stockholders will get their portion. And voting rights are typically withheld from preferred. That stays with common. So let's look at a few examples here of issuing stock. So let's journalize Mustang Properties following stock issuance transactions. On June 19th, they issued 1,000 shares of $1 par common stock for cash of $8 per share. So let's think about what it's telling us here. We're issuing 1,000 shares, which we've set at $1 par value, but we're selling them for $8 per share. So how much cash are we getting? We're getting $8,000 in cash because we're selling 1,000 shares at $8 a piece. Common stock is recorded in the books at par. No matter what you sell it for, it's recorded at par. So we're going to credit common stock at the par value. So we sold 1,000 shares that has a par value of $1 per share. So the common stock is credited for $1,000. But we don't balance. This is because of that new account we saw in the Stockholders Equity section. It's called paid-in capital in excess of par. Well, we issued this stock $7 above par. That's what's in excess of par. So our paid-in capital in excess of par common stock would be $7,000. And now we balance. On July 3rd, we sold, when we're talking about stock, sold and issued are synonymous. They're the same. So we issued or sold 300 shares of 4% no par preferred stock for $15,000. So let's talk about a few things. Look at the 4%. That is your dividend rate or your dividend yield. 4%. So it really isn't really playing a part in this particular scenario as we're just journalizing the transaction. And dividends isn't part of this transaction. So this is also a no par preferred stock. So anytime you have a no par preferred stock, you journalize it as if you are issuing it at par. So we're getting cash of $15,000, and because it's a no par stock, we're treating it as if it were issued at par. So we would credit preferred stock for the $15,000. On July the 11th, we received equipment with market value of $20,000. And we issued 3,000 shares of our $1 par common stock for this equipment. When you're getting an asset other than cash for an issuance of stock, you're going to record that asset at its market value. Now note here, it's really only $3,000 par value of common stock. But stock is very volatile. It goes up and down. Our stock could be worth $20,000 right now. Those 3,000 shares could be worth $20,000. That's the reason we're giving them 3,000 shares for this $20,000 piece of equipment. That's highly likely. So equipment will be recorded at the market value because of that stock volatility. But remember, common stock is always recorded at the par value. So we're going to credit common stock for that $3,000. 3,000 shares that are $1 par value each. And do you remember what the difference would be? Right, paid in capital in excess of par. $17,000. That's just a plug figure there. The next question before I go to the next slide, we want to calculate or prepare the paid-in capital section of our Stockholders Equity section of the balance sheet. So look at our transactions here and think about what actually will appear in the paid-in capital section. Remember, if you're asked to calculate total paid-in capital, you are not simply looking at the paid-in capital in excess of par. That account is part of paid-in capital, but it is not total paid-in capital. Remember, the paid-in capital section of the Stockholders Equity section on the balance sheet contains preferred stock, common stock, and paid-in capital in excess of par. So those three things would appear in the paid-in capital section. So we go get our preferred stock, which was $15,000, our common stock, which was $4,000, and our paid-in capital in excess of par. I believe there were 2 transactions with that, which totaled $24,000. If we add up the 3, we get total paid-in capital of $43,000.